What's a mortgage? My son's going to tell you what mortgage is. Here he is.
A mortgage.
Yeah, exactly.
It's a beautiful day out, so I figured what we'd do is hang outside while I'm going to explain what the mortgage is today. So, overall, when we're talking about a mortgage is a loan that a bank or a lender provides that could be as long as a 15 or a 30-year loan that you would need to go ahead and pay back over a lengthy period of time. It usually includes interest, and it also includes a principal that you'll be going ahead and doing as you're paying it. The interest is a varying. Well, it could be fixed. It could be a variable interest that they offer. The interest varies though as to what interest you would get at the time you actually get the loan. The interest changes on a daily basis. There are all various types of loans. So you have bridge loans, construction loans, FHA loans, conventional loans. There are all types of loans. And there are the specialized loans like ARMs, which we'll talk about another time as well. But these are all various types of loans that are offered. And those loans, they're provided for that mortgage, so therefore you can go ahead and make that purchase on the property. It holds, in other words, the property as collateral for the actual loan itself.
Alright, so to summarize basically on what was just mentioned here, typically what happens is you have the borrower and the co-borrower. It could be borrower, just one person coming for that loan, or the co-borrower, which would be two borrowers coming in to grab up that loan. Now, typically when they get there, they have to meet up with the lender, and when they're speaking with the lender, they're going to together go ahead and formulate and create a contract. Now, that contract typically is going to require some form of a collateral if the lender is going to be going ahead and providing funds to the borrower in order to purchase that home. That's what it is. And that home is the main thing used as collateral to allow that purchase to commence. Now, the reason why the lender does that is because the lender wants to make sure that when they're out of generosity providing funds to the borrower for them to go ahead and make that purchase, that they are in return, first off, getting something for that through some kind of interest they're getting compensation, but also, secondly, that they are protected as well. And that protection would be the ability to grab up that collateral if at any point in time something bad was to happen, such as non-payment or things in that nature. So in general, that is what the process is with regard to grabbing up a mortgage, we'll say. It all revolves around the loan. So looking at this next image here, remember previously I mentioned that there were bridge loans for types of mortgage. There are bridge loans, I said again. There I also mentioned there were conventional loans and FHA loans. However, there's also loans that are called VA loans, jumbo loans, and even USDA loans. So, and there's even more loans than just this I'm mentioning, but these are just some of the few that I'm just pointing out again. And these loans are very, very helpful in various ways, and I'm going to get to those in later videos as to how they are helpful in various ways to ensure that that borrower is able to go ahead and get the funds needed to be able to get the home of their dreams, we'll say.
If you are to go ahead and at any point in time stop paying on the loan at one point or another, the lender could have the potential to foreclose on that loan. And when they foreclose on that, that means they would take the property along with it as well. And they would set the property up for a new sale and sell the property again. That's kind of how that works.
Let's take a moment to dive into a visual explanation on foreclosures. So, pretty much how foreclosure usually comes about is, in most cases, the borrower is usually not able to go ahead and continue payments on the property to be able to afford to get the property. Some kind of situation occurs. Maybe one loses a job or something like that, or the expenses are getting too high and they're not able to go ahead and cover the property itself. And if that is to occur, typically the borrower will not be following through on their agreement. If they are not following through on their agreement, that causes the agreement to void then. If that agreement voids, now what happens is the lender, well, typically the lender will send out warnings and and notices to the actual borrower, letting them know, like, hey, you have a notice, you need to make sure you're making payment. Hey, this is a second notice. Hey, this is a final notice. And eventually, when they get to that point, though, what will happen is the lender will go ahead and foreclose on the property. They'll void the contract first. They'll foreclose the property. And then, now, when they foreclose on that property, remember in the contract, they made sure the home was theirs as being used as a form of collateral. So what would happen is that they can get their money back that they borrowed to the they lent to the borrower. What they're going to do now is they're going to go ahead and take the property under their own hands now, so they have the right to take it under the contract, and then they're going to go ahead and put that property up for sale. Typically, they'll put it into an auction, and we can get into all those other detailed aspects of a foreclosure later, but generally speaking, that's kind of what they do if a mortgage is ever to go ahead and fall through because of lack of payment, which leads it to foreclosure. But yeah, in general, that's a general summarization of kind of what a foreclosure is.
So, in short, a mortgage, though, pretty much, there are two various types, in most cases, of mortgages that most people get, usually. The 15 to 30-year fixed. In most cases, what most get. If interest rates are kind of wonky, sometimes those will get an adjustable rate mortgage at times that they can go ahead and change, and then they can change over to a fixed rate type of mortgage later when the interest rates go down. Beyond that, though, there's not much more else to say about mortgage. However, though, I will say this. Mortgages, without them, we would not be able to actually afford, us typical citizens, a home. Because we need to have a loan, in most cases, to be able to afford that mortgage. Or we'd be saving for the longest time to be able to get that home, that dream home. So to be able to get a mortgage is a big plus in the world we live in today, for sure. So anyways, that's all we got on mortgages for today, and our topic here. So don't forget to like and subscribe. Hope to see you guys soon again then.